Hey, I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different from everything else out there. I bring together new and aspiring investors on each and every episode and let the aspiring investors ask the questions that they need answered. And if you're an aspiring investor yourself, you probably have the same questions. So before you get to this episode that we have prepared for you, make sure you hit the subscribe button and that little notification bell to make sure you get notified every time we post a new episode. And now, enjoy the show.
So that said, Jonathan, we have Rich on the line. What do you want to ask him?
Do you have any KPIs that you track in terms of how to keep your investors satisfied? Like what's the feedback that you're getting from people you're bringing onto your deals?
I wish I had a fancy answer for you there, Jonathan, and we had all these KPIs that we track. But I'm going to answer your question in this fashion. So I think there's specific metrics that we know are the best return on our capital raises, like the biggest levers, if you would. And some of those include hosting a meetup, going to other meetups, networking, being consistent with content. So publishing a new podcast episode every single Monday morning. You do that for 2+ years and people start to trust you a little bit more, right? Yeah. Rubbing elbows and networking with those that are in areas and places that I want to go. Elevating your circle. Like I never want to be the smartest person in the room, obviously. And networking with high net worth individuals.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe, coming to you today with another Ask the Expert episodes. Very excited for today's episode. We've got Rich Summers and Jonathan Tonks on the line with us. And, as is our tradition, Rich, as the experienced investor, you're up first. So welcome to the show.
Brian, thank you so much for having me on the show today. I'm a big fan of everything that you're doing, and it's an honor to be here. I'm excited for this conversation.
Awesome. And something I'm a big fan of is the Multifamily Takeoff podcast as well. And was very happy when you guys reached out to me. It's been almost 2 years. I can't believe it. But episode 24, was the one we were on. And something that I really like about it. Why do you guys call it the Multifamily Takeoff podcast?
Yeah, so the three of us co-hosts, we actually have a background in air traffic control. That's how we all met each other. And so we wanted to incorporate a little bit of our aviation background into the name there.
Yeah. And I don't remember which one of your partners, but one of them was on the same ship as I was at different times. But my background is in military Marine Corps aviation command and control as well. I was never like an air traffic control guy, but I had a lot of them working for me. But yeah, there was a lot of similarities, a lot of synergy when we were talking. But anyway, love that podcast. Love what you guys are doing. Also, huge fan of your Instagram channel too. So I think you got a lot of good stuff going up there.
Appreciate that. I think to answer your question, I believe it was Mike Ty. I'm actually going to have dinner with both of them this evening, so I'll have to run that question by them. I'm curious myself now.
Yep. So, it probably was. So let's talk a little bit about your background and history. So give us an idea of, where you came from and what brought you into multifamily.
Yeah, so I grew up middle class. My mom is an immigrant from Taiwan. Both of my parents know the value of working hard and saving your money. I was taught from a young age to go to school, get good grades, go to college, and get a job. And for the most part, that's what I did. I have a background in retail and sales. I always worked a little retail job since I was 16 years old. While I was going to college, I worked in sales as selling cell phones. And later I sold cars, and that was the first time I really realized that I could kind of, to a certain degree, control my paycheck. And so I really excelled at it. I really enjoyed it. And I wanted to sell commercial real estate when I got out of college. 2008, I graduated. I interviewed with CB Richard Ellis and Grubb & Ellis, a couple commercial brokerages. And it was 2008. Real estate was starting to take a turn there, and they pulled both of the internship positions. They said, "Hey, we love your hustle, but this is not the right time to get into the industry." And so I found myself working on a car lot, selling cars, figuring out where I'm going to go with my life. And I kind of stumbled into an application with the FAA as an air traffic controller. They were hiring at the time people with no experience off the street. They offered me a position. They said, "Hey, can you be in Oklahoma City in 2 weeks?" I said, "Sure, let's do it." I packed up a car with one suitcase, drove out to Oklahoma, That's where the initial training was. I ended up doing this profession for 11 years, 6 years up in LA, 5 years down here in San Diego. And along the way, I read the book, Rich Dad, Poor Dad, remembered real estate and thought, man, I got to get back into real estate. What am I doing? And so I just became obsessed. I started listening to podcasts. I started reading books. I started going to networking events, literally anything I get my hands on to educate myself and network. I did real estate. I started learning the terminology, NOI, rent growth, LTV, all that sort of stuff, and really started focusing and honing into apartments. And at the time, I did what everyone told me not to do. They said it was a little bit too risky. I cashed out my 401k and I took out a home equity line of credit against my primary residence here in San Diego. And started buying some cash producing real estate. My first deal was 11 units in Cincinnati. Shortly after that, I joint ventured with my two partners today. We went in on a 32 unit building in Indianapolis, which we actually just sold 2 weeks ago. We just went full cycle on that deal.
Nice.
And then launched a podcast, learn how to raise capital, took down a couple larger syndications last year in North Carolina, 150 unit complex, the Arbors, and 145 units shortly after Timber Creek Apartments, both in Greensboro, and started buying some short-term rentals along the way. And fast forward to today, I've walked away from the air traffic job and I'm full-time real estate, been full-time for over a year now. Best decision I ever made. And this year we're launching a fund to go buy short-term rentals with our investors. And I've also launched a company in the short-term rental space where we help clients buy short-term rentals that we feel would do great under our watch in select markets around the country for as little as 10% down. And our team will design, furnish, manage all the day-to-day operations, making the experience hands-off to the investors. So that's kind of my story in a nutshell.
Love it. Love it. Now something you mentioned, and I love it when people go against conventional wisdom, selling, basically when you cashed in your 401k, walk us through why you made that decision.
Well, first of all, I knew I needed cash flow so I could quit my job, right? And so my question was, okay, do I leave the money in here and let it slowly grow over time and I'll have a nest egg when I get done? Or I can take this money out and I can use it to kind of jumpstart my real estate investing career. I mean, you don't need capital to get started, but it really helps if you have a nice little nest egg to kind of get your feet wet with your own money. Before you start raising money from others, right? And so the 401k model does not provide cash flow. It does have some pretty steep penalties and fees and taxes that will trigger if you pull that money out. But, I decided to move forward with it. And looking back, it was the best decision I ever made. All those risks that people allude to, Brian, all those risks of cashing out your 401k and jumping into real estate, those risks are real. So put some weight on them. But on the other side of the balance scale is another risk. And it's this: I could be 80 years old one day, laying in my bed, staring at the ceiling, kicking myself because I never tried anything in life. How about that risk? Because that's a risk that a lot of people don't talk about.
Yeah. And something else. And I remember having a conversation with a good friend of mine, and we're both military. This was probably 10 or 12 years ago. And I was investing heavily into the military's version of a 401k. And I remember him telling me that was the dumbest thing I could do with my money. And I was pointing out, I just spat out the conventional wisdom right back at him. I'm like, no, it's like the lowest fee retirement plan you can get and blah, 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 blah. And I remember his answer. He's like, yeah, but you've got to wait until you're 60 to even use that. He's like, I'm still investing, but the investments I'm making are paying me now. And that was the first time that I ever heard anybody, with that kind of contrarian point of view. The 401ks, the retirement plans are good for something. And that's if you want to, work until you're 60 or 65 years old and then relax and rest and retire.
And that's a great point. I mean, it's a slice of your hard-earned money and time that you'll never get back. How dare they say you can't touch this money till 59 and a half? I mean, think about going into a local bank or credit union to do a withdrawal and they say, hey, Brian, we know this is your money, but it's ours until you're 59 and a half. Like, that's crazy to me. I don't know how that's the norm, but
Yeah.
from somehow something happened back in the 1980s, and it's been pushed on the middle class for decades and decades now, and it's the norm, which is crazy to me. And if you actually study the model, it's not a very successful model. I believe the average 401k balance for Americans at retirement age is less than $100,000.
Mm-hmm.
That's not really enough to live off of for most people.
No, and I've seen a lot of the numbers recently on retirement stats, and it's kind of sad what state a lot of people are in as far as what they've saved for retirement, what their net worth is at retirement. I'm in the 40 to 50 age group. Unfortunately, I'm on the upper half of that already, but
you look a lot younger, man.
Yeah, just for men really helps. I'm teasing. I don't, but don't use that. But I saw a stat recently saying the average net worth for somebody between 40 and 50 years old is about 250,000. And it's just one of those things where you're earning your money. Make it work for you. And I think that's like the rich dad poor dad philosophy. That's every investment advisor will preach the same thing. Make your money work for you. It's just different vehicles, different ways to do it.
And I bet you that average of 250K would be significantly less if there wasn't any real estate involved.
Yeah. If it wasn't your primary house involved in that one as well, but
right.
Yeah. So interesting. I liked your answer on that one. I mean, you're right. There are risks to pulling that out. But there's also the opportunity risks to not do it. And incidentally, I did take advantage of the TSP, the thrift savings plan, the military retirement plan. I think all retirement plans have the same rules. You can pull it out for a single family primary residence purchase. I've done that twice. Taken my retirement funds out, bought a house, lived in it for a short period of time, turned it into a rental, and moved on. And then a couple of years later, did the exact same thing. So there are ways to make that money work for you now. But yeah, in general, I love how you say it. How dare you tell me I can't touch that until I'm 60 years old? I mean, but
100%. And then to take it a step further, you can start taking withdrawals at 59 and a half. But if you study the model, I believe it's age 72 and a half. They actually start penalizing you if you don't start taking large chunks out because they know you're about to die. I think the average life expectancy is like 78, 79, and they want to collect their income taxes on that money before you die, which is crazy.
Yeah, I think that's all about taxes. The way it's set up is, hey, we're going to give you a little bit of tax advantage, but we got to make sure we eventually get, our taxes from you. Is how that works. But anyway, that's it. Let's talk about some of the deals you guys have done. Tell us about your first, your favorite, your most recent, whatever you want.
Yeah, I think the favorite so far is probably the 32 unit building that we joint ventured with Sean, Mike, and myself. We all cashed out our 401ks to go into that property. 32 units in Indianapolis, good submarket called Greenwood, good schools, a lot of population, employment growth. It was located very nicely next to a nice shopping mall with a lot of good retail, etc. But we bought it from a slumlord. This lady had owned it for 30, 40 years with her husband. Her husband had passed away. They had 6 down units. They had a lot of the rents were very low, significantly low, had all the problems. I mean, I remember being out there for the inspection day. We saw a drug deal go down. We saw some prostitution. Later in the afternoon, the cops showed up and arrested a couple of the tenants. So this property had it all. And we went in and, closed on this thing and put together a business plan. And we ultimately were able to execute, but we had a lot of ups and downs along the way. We ran out of money along the way. COVID hit like shortly after we were, renovating the first batch of units, trying to release them. We're using third-party property management and we're living out of state in California. So that was another issue that we had to deal with. But the point is we were able to find a solution to all these issues and overcome a lot of those challenges. Success is never a straight line. And fast forward to today, we were able to sell 2 weeks ago, actually. So we bought this property for mid-30s a door, and we're able to exit at almost 100 a door in just over about 25 months of ownership.
So I would imagine, 30s a door was heavily discounted because of the condition it was in.
Mhm.
And we've had a lot of market. So best guess, and throw a dart at a dartboard if you have to, roll a die. But how much of that difference, the 70,000 difference between purchase price and sales price, do you think was your value add plan, and how much do you think was market driven?
Yeah, so a value add in terms of what we put into the property,
Yeah.
we put high teens, close to 20 a door into the property
Mhm.
when it was all said and done. A lot of deferred maintenance. We had to, recoup and fix a lot of the balconies that were
Mhm.
sagging and all this sort of stuff. But I would say I would say 60% of it was our value add strategy. And then the other 40% was just the market just going crazy. We
Yeah.
got initial plan was to hold the property much longer.
Mhm.
Um, but the property next door got listed with multiple offers, and we happened to have a relationship with that broker, and we heard the whisper of where these offers were rolling in, and we thought, holy
Yeah.
cow, this is crazy. And the broker said, look, don't even finish renovating the other half of the units. And you always want to position your property and think
Mhm.
about the next buyer, and so
Yeah.
sometimes that means leaving a little bit of meat on the bone. But this particular broker said, right now with this climate, this market's so crazy, buyers will actually pay more for unrenovated units than they will renovated units. And so
Yeah.
we decided to, market it that way as a well-positioned value add property with proven rents.
Mhm.
And we're able to go full cycle on it.
Yeah. That's something that, as somebody looking for properties, if the property self comps, if you've renovated, a certain amount of units, there's a lot of things that you can pass on to the new owner or to the person who's looking at it that is really attractive. I mean, you can tell them, hey, it costs us exactly this much to renovate those units. Of course, prices are going to fluctuate. They may do things slightly differently. But, if I'm an underwriter looking at that property and you're saying, hey, we did this many units, here's our budget for each one of these, I can go in with a lot more confidence with my underwriting, knowing that. And the same thing with the self comps, the unit prices. You
Mhm.
can look at the rents of the renovated units and the rents of the non-renovated units. And,
Mhm.
as an underwriter, gives me a lot more confidence on my numbers just by looking at that. I don't have to worry about comparing apples and oranges, to the neighboring comps. So yeah,
Totally.
a lot of good reasons why people, love that, um, why sellers leave a little bit of meat on the bone and why the buyers, really want to grab that stuff. So, well, congratulations on that. Going full cycle is something we have yet to do, and looking forward to our first one, but hopefully
Mhm.
soon. Um, anyway, so one question I'd love to ask everybody is about motivation. What is your big burning why, as I like to call it?
Yeah, well, we touched on it a little bit earlier, Brian, but my why really is I don't want to grow old and have any
Mhm.
regrets.
Yeah.
And without taking risk, you cannot grow, and without growing, you will never live to your full potential. And that's my true why.
Yeah. I love it. I love it. Take a little bit of risk, grow, personal growth. I think that's
Mhm.
amazing. All right. So last question before we bring Jonathan on and put him in the spotlight. What's next for you?
Yeah, so it's been challenging, Brian, for us to find
Mhm.
deals to pencil. The two larger deals we bought last year, those deals are just not available today.
Mhm.
Cap rates have compressed, yields have come down. We're seeing broker listed deals in our markets, at least, where if the guidance in terms of the pricing guidance is competitive, we might see 50 property tours and 40 offers. And by
Yeah.
the time you get to best and final, you're going to have to overpay, because a lot of these guidances, I mean, we can't get these deals to pencil, but we always circle back with the brokers a couple months later to see where these deals
Mhm.
traded for. And they're trading for millions over what we didn't even make sense of it. So
Yeah.
sometimes we feel like you got to give what the defense is giving you, and so we're going to pivot our focus into scaling the short-term rental side of the business for 2022.
Mhm.
We have a lot of other friends in this apartment space that they're finding ways to take deals down in other markets. And I think a lot of those operators that are buying those deals are actually going to do well, because I believe we're in a extended inflationary period
Mhm.
with this market cycle. And considering, all the money supply that has been printed in the last 18 months, they're still printing money. And the shortage of housing across America. I mean, it's not just apartment units, it's single family homes, baby
Right.
boomers. You look at the demographics, baby boomers are living longer. They're not going into retirement homes as early as they used to. The millennials, or that demographic, is looking to, start families and buy their first homes. And then we got the Gen Z behind us, I believe it is. They're moving out of their parents' house for the first time, and they're looking to rent apartments, et cetera. So I think we're in an extended inflationary period. The fundamentals look really good. So I think those that are buying, I think they're going to get paid off ultimately at the end of the day. But to answer your question, what's next for us is this year in 2022, we're going to launch a fund with our investors to go buy short-term rentals in select markets around the country. We feel like we're going to be able to provide much better cash flow and cash on cash returns to our investors by doing that.
Nice. Yeah. And there's a lot of talk about, where we are in this cycle. Some people are a little more doom and gloom in their estimates, thinking that, eventually things are going to come crashing down. Other people think we're going to keep on going. I tend to have the same philosophy as you. I look at the supply and demand imbalance. I've seen reports in the last year saying we're 4 or 5 million housing units short, depending on who does the study. And then the demographics as well. In the last 2 years, I've had 2 kids leave my house, and guess where they're living right now? Apartment buildings, right? So a lot of dynamics going on that then you had that inflation, that big elephant in the room. It's something that is going to be persistent for a couple of years. You throw those factors together, and I think real estate in general is still going to do well. Right now may be a good time to pivot. It may not, multifamily, I think, is still going to be strong over the next several years. But if you're able to pivot and find something that may be a little stronger, have a little more cash flow, or meet your investors' needs, it's a good time to do it. So
it will. And to your point, Brian, I mean, I feel like because of this lack of supply, it's going to take at least 3 years for them to build enough product across the country in order to meet that demand. And so that's why I'm very bullish over the next 3 years. I'm speculating, of course, so I could be wrong, but I'm willing to be wrong. And another bold statement that I have is I believe interest rates will be lower 2 years from now than they are today.
Interesting. Now that's one that a lot of people might argue with you. The first point, the National Association of Realtors report said it would take 10 years to close that supply and demand gap. So I think 3 years, they're going to put a big dent into it, but to really close that gap nationwide, a lot of professional reports have said, it could be in the double digits as far as time frames. So
I agree. I think I totally agree with you, and I wouldn't be surprised if it took that long. I think just from the sake of being conservative, I think the next 3 years are relatively safe.
Yeah. And I do believe we're going to be in a persistent low interest rate environment myself. I don't know how low is low, and same for cap rates. I think we're going to be a persistent low cap rate environment, but how low can it go?
And if you study interest rates since, the 1980s and 1990s, I mean, they've continually compressed. And if you look at this market cycle that we've been in, I mean, it's lasted 11 going on 12 years now, since 2010. At any point in those 11 to 12 years, had they increased rates 1 to 2 points, or 100 to 200 basis points, we would have already went through a recession. You know what I mean? And I think none of these leaders, Jerome Powell and Biden, they don't want the recession to start under their watch. No one wants it to start under their watch. And if you think about, last year and I guess it was 2 years ago already, 2020, I mean, we went through a black swan event. The entire world shut down. And to think that there was no recession, at least from a real estate standpoint, that came out of that, that's pretty damn impressive.
Yeah. And it's because of all the money that was printed that you mentioned earlier that we didn't, that the Fed reacted quickly. They kept rates low. I mean, they were talking about raising rates in, late 2019 and ended up lowering the rates, dropping them down. And anyway, you're right. It is absolutely amazing that, multifamily and real estate in general has performed as well as it has. So, well, that said, we're going to shift gears here and bring Jonathan on. So Jonathan, welcome to the show.
Thanks so much, Brian. I'm happy to be here. I just got to make a comment real quick. Rich, I happen to be in the Gen Z category here. So I'm thankful I'm not living with my parents at the moment.
Love to hear it.
Where does Gen Z officially begin?
I believe it's 96.
96.
First year.
Okay.
So I'm a 97 baby.
All right. I've got... it's depressing. Yeah, my oldest daughter was born in 99 and then 2002. I am not old enough to be your dad is what I'm going to say, but definitely not. But yeah, Gen Z, wow. They're poised to do a lot of great things, I think. So that said, Gen Z or Jonathan, tell us a little bit about yourself.
Yeah, man, happy to. Thanks again for having me on the show, Brian. And I would say I started off as my college career went through mechanical engineering. I had come from a family of automotive people, and specifically through the GM of the big three. And that was the route that I had planned for my entire life. I want to be just like my dad, work up the corporate ladder and really provide for my family through that route. But I would say it changed really once I was midway through college. I had an opportunity to study abroad. I was in Germany for about 6 months, and just enough time for me to have some isolation, some solitude, really some time to think. My buddy introduced me to Rich Dad Poor Dad, which I thought was fascinating. It did not click the first time I read it. I had to read it a couple times. I thought it was a great strategy, great information through the book, but again, he encouraged me and I read it again. But really around that time was when I was just interested in business, trying new things, doing little side hustles. And it really wasn't until I graduated, moved out to where I currently am in West Michigan. And with that opportunity, I rented for about 15 months. And when that lease came up, my rent was getting jacked up 40%. And this was before COVID happened. So this is even before all the compression was happening. And I realized that, hey, I'm going to try my hand at getting a duplex, house hacking for a little while. And I did. I moved closer to work. I house hacked, and really I understood right from the get-go. I was blessed with an incredible tenant, and he's been fantastic, pays on time every month. Really blessing there. But I knew from the standpoint in talking to many people who have a small residential real estate experience that it takes a lot more to scale at that volume and that size of asset. So I looked and went to I went to meetups, just trying to look for mentorship, some coaching. I realized it wasn't something I could do on my own, just based on how long it took me to get into a duplex. So I joined multiple meetups locally and across the nation, and thank God for the Zoom capabilities that came up with that, because I was partnered with some amazing people, right? And they put me towards, or pushed me and encouraged me towards a few educational platforms. And I've joined Rod Cleef, his program, joined his group, got some coaching through there, and really just some amazing opportunities to get involved into the multifamily space, co-GP on an apartment last year. And really that was the first step into this experience. And that's what's brought me here today, is just continuing the education, meeting as many people as I can, and having awesome conversations with guys like you.
Yeah. Awesome. I think networking has been absolutely key for me, and it's something where I think I've had the biggest leaps forward through networking. You find people that help you unlock that little, whatever that hurdle is you need to get over. At several networking events or conferences that I've been to, I've heard somebody or watched somebody do things that have just like, wow, I can do that too type stuff. So, I can never understate, how important that networking aspect is. And then the other thing you said is the mentorship. There's paid mentorship, and there's like there are other ways to get mentorship programs. I went through a pay to play program, and I think it was also fantastic. I'm glad you're able to find one that works for you, but having help along the way is absolutely vital. So, good on you for doing what you're doing. And I love it. I love it when, Gen Zers are buying duplexes and house hacking already, because, I look back and I'm like, man, I wish, when I was your age, I was doing what you were doing. So good for you. But that said, what's your motivation? What's your big burning why?
It's a great question, Brian, and it's something I have to be honest, I've struggled with for quite a while, just trying to understand where does that passion and that motivation come from, and really haven't been able to articulate it as well as I believe I can now, just based on where I'm at currently in my life. But I believe God blesses us so that we can be a blessing to other people. And that really pushes me, because it comes from the standpoint of the things that I have and the opportunities that come to me, they're not my own. They're given to me as an opportunity for me to seize that moment. But then also always remembering that there's plenty of ways for us to give back. And that really pushes me a lot, to have that abundance mentality so that we can continue to help bring other people up.
Yeah. Yeah. And so something I've noticed, a lot of religions have the same philosophy. Christianity, it's the golden rule, you do unto others as you'd have them do unto you. But what I've noticed in my life is the golden rule is really golden, and what I mean by that is, the more we do to help other people and bless other people's lives, as you put it, the more it's like a virtuous cycle, where we're blessed, we receive and we give, and that leads to more and more and more, and just keeps on, cycling upward and upward. That abundance mentality, it's a real thing. It is. So very much appreciate that. So that said, Jonathan, we have Rich on the line. What do you want to ask him?
Rich, I got plenty of questions for you, brother. I love your experience and what you bring into this. And I wanted to jump off of really quickly. I wanted to get this plug in here. So as an air traffic control guy, with your partners doing that as your background, when you guys started Pac3 Capital, was that an area where all three of you had similar experience, or did anyone bring to the table previous apartment investing experience before you started?
Yeah, that's a great question. So when we started together, Mike had bought a fourplex in Cleveland. And I remember, that's kind of what got the wheels turning for me. He was in the break room at our air traffic control job. This is years ago, talking about this fourplex he just bought in Cleveland. And I thought it was the coolest thing ever. And so that's what kind of like how everything kind of came to fruition. But outside of a little bit of experience such as that, no. I mean, when we formed Pac3 Capital, we had experience. We had bought the 32 unit together. I had bought my 11 units. So we had a little bit of like experience getting our feet wet, if you would. And we had read a lot of books and podcasts and that sort of thing. And we also, like you, had a mentorship program that we participated with. We had a guest on our podcast early on by the name of John Azar. Him and his brother Tony have bought, 8,000 apartment units over the years in the Carolinas, Georgia, in the Southeast. Exactly. Brian knows of them. And they didn't have a formal mentorship program at the time, and that was exactly what we were looking for. We wanted to work with some guys that were more interested in buying assets versus building an education business, and we're able to kind of work out a tailored custom mentorship program with them.
Nice.
Was it actually a partnership that you formed with those guys, or is it more so they were in your corner with questions?
They were in our corner. They basically taught us everything from, capital raise, building a brand, attracting investors, how to underwrite larger deals, basically the A to Z. But we actually ended up co-sponsoring on those 2 syndications with them, which was great.
With your business, what are areas that you have automated?
Yeah, so we've at the beginning, we did a lot of the things ourselves, pretty much everything ourselves. And then we slowly started to automate and delegate certain things, starting with the lower priority tasks, such as podcasts, right? Scheduling guests, getting guests to come on, editing files, show notes, all that sort of stuff. So we have a assistant that does a lot of that stuff for us. And then our networking events. So we host a monthly networking event here in San Diego, automating that, delegating a lot of that stuff out. So we have an assistant that goes and shows up early and checks everyone in, does name tags, make sure we got, copies of their email address, phone number, that sort of stuff. And then a lot of our social media content, we do a lot of that. We used to do a lot of that ourselves, but now it's all outsourced. And then that's kind of freed up our time to focus on higher producing activities, such as looking for deals or strategically growing the business, if you would.
Yeah. All I got to say is it's amazing how much time you get back when you start outsourcing things. Just with the podcast editing, when I started, hiring somebody to do the podcast editing, how much time I ended up back in my own hands, and so I think I think a lot of people need to be able to do that. And a lot of people like me had a hard time giving up stuff like that. But if I had to go back and do things over again, I would have outsourced a lot of that stuff a lot earlier.
Yeah. And like another tip is like the value of your time. This was an aha moment for me not too long ago, but I'll give you an example. So I was refinancing that first 11 unit deal that I had purchased, and the appraisal came back a little bit low. And so I spent 1 hour of my time going over all the recently sold apartment buildings in the Cincinnati area that I felt would help my cause. So I spent 1 hour going over it. We sent it in for an appraisal dispute, and that 1 hour actually increased my loan proceeds on the refi by almost $60,000. And so once I saw that, I was like, okay, my time is now worth $60,000. So anything less than that, especially the $15, $20, $50 an hour tasks, I'm just not interested. I had an offer last week. Someone called me and said, hey, would you be interested in doing real estate apartment coaching for me for $250 an hour? And I said, I'd love to, but I declined it because I know it is an opportunity cost to everything. And those hours I'd be spent, for $250, I could be returning much, much higher ROI if I was spending those hours building and working on my own business, if you would.
Do you think the main reason why you initially got that first VA or first person to help you along with that, was it out of necessity, just you guys physically didn't have the time, or was it that aha moment that made you say, let's look into getting someone to help?
Yeah, it was a combination of a few things. One of them was I just hated doing all those tasks daily and weekly. Just like dreaded doing them, and it was starting to consume a lot of my time. And so both of those things coupled together gave me the motivation to go reach out and find some help and start delegating. They say delegate to elevate. And that is a true thing. You have to delegate in order to elevate your life. That's 100%, and your business.
I love it. Now, with your expertise with equity raises and bringing the capital into deals, do you have any KPIs that you track in terms of how to keep your investors satisfied? Like, what's the feedback that you're getting from people you're bringing onto your deals?
Yeah, I wish I had a fancy answer for you there, Jonathan, and we had all these KPIs that we track. But I'm going to answer your question in this fashion. So I think there's specific metrics that we know are the best return on our capital raises, like the biggest levers, if you would. And some of those include, hosting a meetup, going to other meetups, networking, being consistent with content. So publishing a new podcast episode every single Monday morning, you do that for 2+ years and people start to trust you a little bit more, right? Yeah. Just rubbing elbows and networking with those that are in areas and places that I want to go. Elevating your circle. Like I never want to be the smartest person in the room, obviously. And networking with high net worth individuals. So, if I go and network with a bunch of people that have no money, that's probably not going to be the best use of my capital raise, And so hanging out with people that have higher net worths, those types of things have been the biggest levers for us, at least. And I'm sure Brian probably has some more info to provide on the capital raise. How do you guys do it, Brian?
As far as KPIs, I think the best KPI is how many people have reinvested, after you come full cycle. Now, we have not come full cycle on our first deal. And, one thing that's on my mind is I want to keep people happy enough with how we've operated the property, how we've communicated and the value we've provided them, that they will come back, and that's one of those metrics that's impossible for a new investor to measure, so, if I had to dial back and something else is, the podcast, creating content, whether it's a podcast, whether it's on LinkedIn, you never know how far that stuff's going to go. So do what you can to build your content creation. And I'm sure Rich has had calls like this before, where you get on the call with a potential investor, accredited investor, and they say, I've listened to a lot of episodes of your podcast. I feel like I already know you. Or I've been following you on LinkedIn for the last couple of years. I'm ready to invest, So, unfortunately, I haven't kept track of how many of those I've gotten, but it's more and more the longer that I'm in the business, it happens more and more frequently, where people listen, they consume the content, whether it's on YouTube, on the podcast, or on social media. They get to know kind of who I am by what I put out, and then want to come into the fold.
Yeah. And I'll give you another example. So like last year we did those two larger syndications. The first one we did a 506B, and that was for the Arbors, 150 units. And that raise went significantly easier and smoother than the next one we tried to do a few months later, which was Timber Creek, 145 units. We decided to pivot and try a 506C, which would allow us to advertise, but we wouldn't be able to bring in non-accredited investors. And to our surprise, we did a lot of social media marketing, and we did a lot of different avenues of marketing, Facebook, that sort of stuff. We even did paid ads on social media and to raise money, and that did not go well. We actually that raise was significantly more challenging for us because we had to say no to so many non-accredited investors. So I think my takeaway, or our takeaway, was a couple things. Like, one, when you're starting off, you don't necessarily have the track record to attract accredited investors yet. And so a lot of the investors you have early on are really going to be friends, family, people in your social circle that already know, like, and trust you. You know,
I got to say, I'm not going to say the word scared, but maybe that's the best word for it, about doing a 506C for that exact reason. You know, if you look at our investor, I think we've had like 240 different people invest with us. The majority of those, probably about 60% of them, are non-accredited. You know, and you look at the numbers. We have more non-accredited investors, but we've gotten more money from the accredited investors. You know, I think that makes sense why. But you know, if we exclude the non-accredited investors from our next capital raise, you know, are we going to be able to hit the same numbers? And I don't know the answer to that yet. So anyway, yeah, I think that's an important distinction to make. You have a little more, you know, ability to reach out and touch people through advertising if you're doing the 506C, but you're excluding a big percentage of, or most people are excluding a large percentage of their networks.
Yeah. For example, like, look at Joe Fairless and Ashcroft Capital. I believe they got to almost 10,000 units and $1 billion of real estate before they pivoted from the 506B and started doing 506C. So I think if you're on the fence about doing the first 506C, I would caution to definitely wait until you know 100% that you're ready to make that move.
All right. Well, we're about out of time, guys. Appreciate you guys coming on. But I do have one more question for each of you. And Rich, you get to go first. How can listeners learn more about you? Yeah,
so you can find me on social, Instagram. I'm at Rich_Summers. That's SOMERS. If you want to learn more about our syndication company, it's pack3capital.com. And if you want to learn more about my short-term rental company, it's fortunecribs.com. And our podcast is The Multifamily Takeoff.
All right. Thanks a lot. Jonathan, same question for you. How can listeners learn more about you?
Yeah, the best way would be through LinkedIn. Just search my name, Jonathan Tonks, or you can look on my website, provisionspace.com. I got a lot of information on there for them as well.
Awesome. Well, hey, thank you both for coming on the show today. Very much appreciate your time, and it's an absolute pleasure. Hey, if you like that episode, make sure to subscribe. But more importantly, if you haven't joined our multifamily educational community yet, which we call the Tribe of Titans, you are missing out. Get 30 days free by clicking the link in the description to this episode, or go to thetribeoftitans.info, and we'll see you there.